Picture this. You open your investment app and your portfolio is down £500. Your stomach drops. You feel it physically. You start thinking about whether you should sell before it gets worse. Now rewind 2 weeks. Your portfolio was up £500. You noticed, maybe you felt good for a moment, and then you got on with your day. Same amount of money, completely different emotional response. And that asymmetry, the fact that losing feels so much worse than winning feels good, is quietly costing ordinary investors a fortune. Not because the market is unfair, because our brains were never built for it. Welcome back to the Investor Center podcast. I'm Isaiah, and today we're getting into the psychology of investing, specifically the 3 mental patterns that trip up even experienced investors, and what you can actually do about them. Before we dive in, if you're looking for the best FCA-regulated investing platforms in the UK with current sign-up offers, head to theinvestorcentre.co.uk. All the links are down in the description. So let's go. The first one has a name, loss aversion. In the late 1970s, 2 psychologists called Daniel Kahneman and Amos Tversky ran a series of experiments on how people make decisions under risk. What they found was striking. The pain of losing a sum of money is psychologically about twice as powerful as the pleasure of gaining the same amount. Losing £100 feels roughly twice as bad as gaining £100 feels good. That might sound like a quirk, but in investing, it shapes everything. It's why people sell during a market dip. Not because selling is the rational move, but because the pain of watching the number go down is unbearable. It's why people hold on to losing investments for too long, hoping to get back to even before they sell. And it's why people who check their portfolios every day tend to make worse decisions than people who check them once a quarter. The more frequently you look, the more losses you see, because markets move up and down constantly, and the more your loss aversion kicks in. Kahneman eventually won the Nobel Prize for this work. The science is solid, and knowing about it doesn't make you immune to it. It just means you can build systems that protect you from yourself. The second is herd mentality, and the easiest way to explain it is with GameStop. In January 2021, a group of retail investors on Reddit decided to buy shares in GameStop, a struggling video game retailer that professional investors had heavily bet against. The share price started rising. Then it went viral. People who had never invested before opened accounts and bought it, not because they'd analyzed the company, but because everyone else was doing it and it felt like free money. GameStop went from around $4 a share to nearly $500 in a matter of weeks. Then it collapsed. Most of the people who bought in during the frenzy lost money. Some lost a lot. Here's what was happening psychologically. When everyone around you is doing something, your brain interprets that as a signal of safety. Historically, following the crowd has kept us alive. In investing, it often does the opposite. The crowd tends to pile in at the top and panic out at the bottom, which is precisely the wrong way around. By the time something is everywhere on social media, the opportunity has usually already passed. Just a quick one from us. If you're building an investment habit and want to know which UK platforms are worth your time, we've done the research. The links are down in the description, including some current sign-up offers. Go check that out and we'll get straight back into it. The third pattern is recency bias, and it's probably the most invisible of the 3. Recency bias is the tendency to assume that whatever has happened recently will keep happening. If the market has been rising for 2 years, it feels like it will keep rising. If it just crashed, it feels like it will keep crashing. March 2020 is the clearest recent example. When COVID hit and the markets collapsed, millions of people sold their investments to stop the bleeding. The S&P 500 had dropped roughly 34% in 5 weeks, one of the fastest crashes in history. It felt like it was going to keep falling. Recency bias told people this is the new reality, get out now. What actually happened was the opposite. By August 2020, just 5 months later, the S&P 500 had fully recovered and was hitting new all-time highs. The people who sold during the crash and waited for things to feel safe again missed the entire recovery. The people who stayed put or kept investing through the drop came out significantly ahead. Recency bias makes the recent past feel like a reliable map of the future. In markets, it almost never is. So what do you actually do with all this? The honest answer is that you can't think your way out of these patterns. They're not the result of stupidity, they're the result of being human. The solution isn't to become more rational, it's to remove as many decisions as possible from the equation. What we do, and what most of the evidence points to for ordinary long-term investors, is set up a direct debit into a low-cost index fund inside a stocks and shares ISA, a fixed amount on a fixed date every month. No decision about whether to invest this month based on how the market feels. No checking it every day and torturing ourselves with the fluctuations. We automate it and step back. Pound cost averaging inside a tax-free wrapper with as little interference from our brains as possible. The market will drop again. Your brain will tell you to do something. History suggests that doing nothing is almost always the right answer. Loss aversion, herd mentality, recency bias. 3 patterns, 1 cause. A brain that evolved for survival in a world that looks nothing like a stock market. Understanding them won't make you immune, but building a system that doesn't rely on your emotions to make good decisions will get you most of the way there. This is not financial advice, it's just information, and we hope it was useful. If you're ready to start investing or want to compare platforms, the links are down in the description. Subscribe or follow so you don't miss the next episode. I'm Isaiah from the Investor Center, and I'll see you in the next one.